And we are live. Welcome to another Wednesday edition of Foundations of DeFi. I am your co-host Marlon, and again, I have the father of DeFi with me, Reggie Middleton. How you doing today, sir?
I'm doing well. Reggie read the
Glad,
directions on his camera and check it out. Automatic
yeah,
zoom.
yeah. You're getting a little too high tech for me, man. I might got to upgrade my system now. I'm glad to see you not flexing the gains today. You know, you kind of intimidating with the muscles the last couple of weeks. It's all good. I'm back in the gym.
I'm usually at the gym, but I've been working so hard. I've been so tired, man. This last week, So
Hey,
it's
you
time
got
for me
you got
to,
to get the rest days in.
yeah.
All right, cool. So, let's go ahead and hop straight into it. We discussed previously just looking into the into what's going on in the markets and the economy lately. Liquidity versus solvency. Do you care to start us off on this?
Yeah. So, I'm looking at my favorite crypto news media outlet, which is sarcastic because I don't really think it's a news media outlet. I think it's a corporate PR tool, which is cool, but it's not the news. We're talking about Coin Desk and Cointelegraph. They say this and that project has liquidity issues. Terra has liquidity issues, and um, Celsius has liquidity issues, and this entity and that entity. And the terminology is being used improperly. Okay, liquidity is basically the ability for you to buy or sell something without affecting its market price significantly. Okay. Now, solvency.
I'm gonna pull up the definitions while you're talking. Go ahead.
You're gonna pull up a definition because but these are written by somebody, etc. But
I'm gonna go to Investopedia. That's my go-to.
okay, solvency is basically balance sheet solvency is having more assets than you have liabilities. Okay, you can have significant liquidity and be insolvent, especially balance sheet insolvent. Now, cash flow solvency is basically the ability for you to have enough cash to be able to operate daily. So Celsius did not have a liquidity issue. Celsius has a solvency issue. They're insolvent. They owe more money than they have. Okay. Same thing with Terra, because the value of their assets went that way and the value of their liabilities went that way. Liquidity does not help that. Okay. Now, you can say liquidity helps it, you can pretend it does, but that's like having a raging fire and someone urinating in a volcano to try and get the volcano to go out. It's not the way it works. Just that simple. This old school finance. It's not even old school
So,
finance. It's actually
so,
business 101 in undergrad, but the little
so,
reality,
so
the
just so
reality to the market.
So just to be clear, liquidity is basically the ability to convert from asset to cash or cash to an asset, whereas solvency is being able to pay off all your long-term debts as a business or individual without going into more debt or having that available balance to pay off all those debts, correct?
Yeah, well, I'll simplify it even more. Solvency is the ability to continue doing business. Okay.
Okay.
Balance sheet solvency means that you have some net tangible equity, which means what you own is worth more than what you owe. As long as that's the case, you're solvent. Okay. But that's using a balance sheet. Using a cash flow, same concept, just different set of statements, meaning that you bring in at least as much money as you send out. Insolvent is you sending out more money than you're bringing in, or you owe more money than you have. Okay, these crypto entities are insolvent because the prices of their collateral, their assets, drop 50, 60, 70, 80, 90%. The liabilities either remain the same, sometimes the liabilities shot upward. They're just not worth anything. They have negative worth. Okay, so you can loan them all the money you want. Okay, that doesn't solve a solvency issue. Now, it's being called liquidity issue. You're wrong. Okay, now you can hope that the market bounces back or market values may bounce back. So if you give them a liquidity pipe to allow them to go and do business long enough for the value of these assets to increase, then they may be solvent at one time in the future. That's gambling though.
So So let me ask you, you mentioned, speaking of Tether, I'm gonna pull up your tweet that had the snippet from the New York Times article. Where is it at? So in the worst case scenario, critics say a downturn could spark the crypto equivalent of a bank run. Traders might all rush to exchange their Tether for dollars, only to discover that Tether could not fulfill those orders. Investors would lose billions of dollars, forcing them to sell their other crypto holdings, causing a potential devastating panic that might spill into non-crypto markets. But according to Tether, they were able to pay off or to give investors their dollars for their Tether, and they lost about an eighth of their reserve, which is equivalent to $10 billion, excuse me, over the course of a week and a half. So in Tether's instance, they were able to pay off the people who were willing to, or that were ready to sell their Tether back for dollars. Would you say that they were solvent, so they are able to continue to do business, even though they lost an eighth of their holdings?
Well, it looks like they're solvent to me. Okay, to put this into comparison, and this is not me favoring Tether or disfavoring him. I'm not saying I like him or dislike him. I'm
We're
just
just
trying to
looking at
be
the
an
facts.
objective observer, right? And objective observer of the market, facts. Okay, they didn't lose their assets. They put these assets in reserve. Those assets are actually a liability backing. Their assets backing a liability, which is the ability for you to redeem them. Okay, they redeemed $10 billion in a week and a half, apparently without a glitch. Only $70 billion of assets. You take any bank with $70 billion on its balance sheet, you make that bank just a week and a half, in just 10 days, produce $10 billion of cash at its cashier window. You know what you're going to have? Bank failure. And that's going to daisy chain along the other banks. Very few banks can do that. So if you're concerned about Tether's riskiness, solvency, then you've already proven that you don't trust the US banking system. Okay, very few banks with $70 billion of assets can produce $10 billion US dollars at the cashier window. Very
Right,
few.
and I remember that was a concern that I'd seen. You know, of course, when COVID first happened, and everybody was talking about some, you know, oh, we need to pull our money out, this and that. It was the banks. If the day came where that happened, the banks wouldn't be able to pay out people willing to take their money out of the bank. So,
Okay,
I mean, is that true? I know people talk
I
about it
think
all the
it's true.
time, but
But let's look at other bank runs. I don't remember the size of Bear Stearns. Maybe you could Google it to see what the size of Bear Stearns was, or Lehman Brothers at the time. They were bigger than $70 billion. Okay, but to put it into perspective, they had a demand for liquidity, and they couldn't produce it. Drove them out of business. Okay, because the counterparties didn't trust them, rightfully so, and then demanded their money. The reason why banks can't produce the money is because there's a very big difference between Tether and banks in terms of business model. A bank takes $100 million effectively, then it goes and borrows another $900 million, or $1.8 billion, $1.9 billion. And then it goes to do banking business. It lends money out, it trades, etc. Okay, it only has a very, very small amount of that money as actual equity. Okay, it does business with borrowed money. They only keep, and it's called fractional reserve banking for everybody who likes to look at the armchair economists on the internet. They perform fractional reserve banking where they only keep a fraction of their assets in reserve. If you demand a significant amount of your money back, they have to liquidate assets. Many of those assets are in long-term investments, 30-year mortgages, 20-year mortgages, 10, 15-year mortgages, swaps, and private equity deals and stock trading, etc. So if they don't have the cash at hand, how do they produce it? You have to go and break contracts and break deals and sell off medium and longer term assets. You do that in mass, you drive the price of those assets down because of the liquidity issues which you discussed earlier, right? Usually the longer term the asset, the less the liquid it is. You drive it down, you get less for it. Okay. And then the market starts to react in the daisy chains. That's why the banks can't produce that much money that quickly in a short amount of time. Tether was able to do it because technically, Tether simply takes money in, okay? It puts it into reserve, allegedly shorter term, higher quality investments. It makes money off of that interest, but it doesn't pay that interest out to the people who buy tethers. The people who buy tethers just want stability in that $1. So Tether takes the money they take in and makes interest off of it, off the investments. And their liability is only that $1 that they took in. So if they could create 1.5% interest off of that $1, they keep that 1.5%. 1.5% might not seem much, but Tether is rocking what, $70 billion. So yeah. So 1.5% off of 70 billion is pretty good money.
Still, what, $700 million, something like that?
Well, it's almost $1 billion. I mean, it's almost almost $1 billion. 1.5% for 70 billion, yeah, almost $1 billion. Okay. Now, if you think about that, right, that's pretty good. But if every dollar was redeemed from Tether, they should, if they do what they're say they're doing in their marketing documents, they should be able to produce all of that and produce it profitably. And you have a redemption fee when you go and get money out of Tether. I can't remember exactly what it is, but they actually make money when they redeem, as long as that redemption fee costs more than it costs them to produce the dollars. So the difference in the business model explains why Tether should be able to, because I don't know the inner workings, should be able to produce it. Now, the rumor is that Tether took their short-term investments and put them in the longer-term and risky investments, like bailing out Bitfinex. Okay, no, that's not AAA. You know, Bitfinex is probably more along a junk rating. You know, but you know whether they did or not, Tether's still alive. Bear Stearns leaving or not, Washington Mutual countrywide or not.
Right. Okay. And just for comparison, when I pulled up the Lehman Brothers by 2008, they had, what was it, around, so in 2004 they had $40 billion made in loans. By 2008 they had $680 billion in assets, supported by $22.5 billion of firm capital.
There you go. So imagine if they had to pay out, what percent was Tether had to pay out again?
It was 10%. No, the eighth. They lost the eighth. They had to pay an eighth of 70 billion.
Yeah, eighth. What's an eighth? What's going to divided by 8 roughly? Quickly.
We're gonna round up and say about 8.5, 9 billion.
No, the percentage. 1/8 is what percent?
12.5%.
Okay, so 12.5% over the total asset holding of Lehman Brothers would be?
Let's see, pull out my handy dandy calculator. Or from 680.
So you're talking 68 billion plus another
that's 85 billion. They would have
about 85 billion. Okay. So what we're saying is that 85 billion right there would have left Lehman Brothers insolvent. Why? What's the definition of solvency? Having more liabilities than you do assets.
Yeah, because they only had 24 million worth in
equity.
In actual,
yeah. Now I don't want to get equity and assets confused, but when it's time to start selling off quickly, what happens to those asset prices? They go down. Okay. And I doubt Lehman Brothers, knowing how risky Lehman Brothers was, and I knew how risky they were way before they collapsed. If you go to the Boom Bust blog, very, very extensive reports written in 2007 and 2008 on most of these banks. And I was 100% correct. Okay, Bear Stearns have still sitting right there. It's called Is This the Breaking of the Bear? And it very, very clearly shows that there's no in the world they're going to unwind these investments if they had to, and they couldn't. So right now, Tether did something that Lehman couldn't. If you look at Lehman going from 40 billion to 680 billion, that's ridiculous growth. There's no in the world you go that fast safely. It is impossible. Okay,
that's faster than Coinbase.
Yeah. You know, drug dealers can't do that. But why sell cocaine? You could be in the banking business.
Right.
You get more money, it's safer, you're protected by the government.
Legal dealings, what they say.
Yeah.
So let me ask you, in regards to Tether compared to some of these other stable coins, for instance, are they an anomaly? Or are they are they, you know, I don't know, what has your research found in terms of, you know, comparing them with others in the space?
You don't need to do research. You have to look at Tether is anchored by, allegedly, as long as they're telling the truth, real world assets. So if the price of Tether drops 50% or 97%, the Luna's stablecoin did, okay, all you have to do is just go to Tether and redeem it. Okay. So better yet, what I would do, stable coins that were backed allegedly by actual $1 each actual dollar, or go and buy up all those stable coins for 2 cents and then redeem them at the window, at Tether's window. That means you're buying dollars for 2 cents. Okay, now you have to pay your redemption fee. Let's suppose that's 1 cent. So that's 3 cents. So you're paying 3 cents for every dollar you get to redeem. That's, you know, that is printing money. So doing that process is called arbitrage, where you take advantage of a gap of logic in the market.
Right.
That's supposed to be risk-free, assuming that Tether is good credit and will honor its obligations. Okay, that's why Tether is never going to drop it so much. The most it would drop is a small spread above or below its redemption fee. So if its redemption fee is like 1%, I'm just guessing. If the redemption fee is 1%, it's allowable to go up, you know, to 101 cents or down to 99 cents, because you can't go in and arbitrage it profitably because there's expense in there. Once it goes any farther past that, the most predictable possible characteristic to make it profitable, and that is human greed. But someone's always going to go in and buy those Tether and redeem it. If it shoots up to 110%, someone's going to go and short Tether. They're going to short Tether, right? So that's going to keep it in a very tight range. Now, Luna and died for MakerDAO, and what's the
compound DAO?
Tron, the algorithmic stable coin. Algorithmic stable coins attempt to use math, right, to simulate a hard backing, a peg. Pegs can be broken. Human greed can't. Human greed has been in existence most likely since man was able to conceive of greed.
It's a natural characteristic.
Right. So it will be there, you know. Algorithmic stable coins, to my knowledge, have never worked over time. Each and every one of them has broken its peg. Now, I love the concept to be able to have a stable value, right? Independent of physical sovereign control. But the problem is there's no human greed factor to back it up in case it goes wrong.
Right. Because
you can make it
from what I've read with the algorithmic stable coins, I mean, it essentially the code based on the data coming in, it can either produce more coins out there or more stable coins out there, or burn more, correct? Depending on supply, demand, and whatever their algorithmic equation is set up for. Is that how it works?
I'm pretty sure some may work differently, but I know the way DAI works, and I didn't look into Luna. I thought Luna was BS from the beginning, so I never bothered to look into it. But the way DAI works and MakerDAO is they do expand, contract the supply of coins relative to where the market used the peg, and it's backed up with collateral. It used to be collateral, just F. Now they've expanded it to beyond F. And do you know what they include in the collateral now? You never guess.
What, the US dollar?
Dollars. The beginning. Back to where we started from, you know? But multi-collateral, multi-peg collateralization is diverse collateralization is a good idea because diversity reduces risk, because it reduces the chance that everything goes on at the same time. Possible, but less likely. But you can't arbitrage stable coins, which means human greed comes in. And there's always going to be something you haven't predicted. When MakerDAO, DAI broke its peg, the price of F dropped so fast that the system couldn't sell the F off to produce, to compensate for the drop in price, because the contract couldn't react so fast. The market linkages just couldn't sell at a certain rate, you had slippage, you had gas fees, etc. You know, it's possible you could have seen that coming, but you wouldn't have to see it coming if you simply use arbitrage, i.e., greed. With Luna, I think something similar might have happened. I know they, real professional market dudes, came in, the quants, and they saw where Luna didn't take advantage of actual real exchange and market machinations. And so they took advantage of it. And that's the rumor. They went and bought a whole bunch of Luna, used the proceeds to buy Bitcoin, or vice versa. Started Luna, went down, and they forced it to go down by buying up all the available collateral. And that's what they said happened. I have no idea. The reason I don't have an idea, it's not that complex. Just never bothered with Luna because I thought it was BS. I'm not trying to knock the guys, Do Kwon and them. I appreciate all entrepreneurs coming up, but the finance thing is really not a child's game, and you really do have to learn it, know it, if you're going to excel at it. It's not difficult. You don't have to be a genius, but you do have to read. You have to have a little experience. Think about getting a whole bunch of investment bankers to read a blockchain, right? Assuming they could do it. Would you really want to put your life savings on it?
I don't know. They're going to be looking at P&L. I'm looking at the technology. It's two different. So
basically, you get a whole bunch of salespeople and they create this blockchain. Unlikely they'll do a good job.
I never agree with salespeople in any of my jobs, so I don't know. I have a tough time with sales folks, and I'm waiting on that Netflix documentary about Luna. Yeah, it's going to be interesting.
And that's right to all you finance dudes out here. I said it. Investment bankers are salespeople. That's what you are. So live with it. All prove me wrong. Okay, I'm easy to debate in public. Hey. So just like you don't want salespeople building a blockchain, you don't want developers building a financial product unless they are led by real deal finance guys. They're all finance guys, and you could do both. You could be both, but most developers aren't. They read a couple of articles, look stuff up in Wikipedia and Investopedia, and they start to build. A lot of stuff is theoretical.
And look, nowadays everybody thinks they're an expert. Everybody thinks they're an expert nowadays after 3 months of doing courses in Google and YouTube. But I think that's where we see a lot of people being a little over in on their heads with some of these projects instead of getting the help or bringing on a subject matter expert to attack some of these fields.
Now, and on that note, everybody being so smart except for me. And I admit I'm just a dad, so I'm the first one. I'm humble pie in front. I went to NFT NYC yesterday. I'm supposed to be there now. I think I'm the only one that paid for it.
Really? So I'm gonna go to this website real quick, Reggie, because I was looking and I was like, man, this
it's a big event. It's a big event.
It's the fourth time they're doing it too, huh?
Yeah, it's a big and I went with my daughter. She's 16, and I'm gonna say it's a bunch of BS. I mean,
I'm glad you said it because
and I'm not saying NFTs are BS. The ERC 721, token, it's very, very utilitarian and useful, but not for this nonsense that they have there. Okay, they actually had guys giving. And meanwhile, nobody invites me to do speeches and presentations. I was telling my daughter, I'm walking her through the claims in my patent. I'm going to admit something. I realize that I am guilty of discrimination. Okay, I was being sexist because I taught my 16-year-old son something that I did not teach my 16-year-old daughter. I caught myself and rectifying it. So I'm doing a massive brain dump on patent law, filing, and reading and evaluating patents, and the economics and the finance, much more so than economics, finance evaluation with tying crypto assets, how it fits into the global macroeconomy. All that stuff I'm forcing directly to my daughter, okay? Because there's just not enough representation of women, and I'm part of the cost. I fought myself. By the end of this summer, watch out for I'm not even gonna give my daughter's name for the people out there who may be doing it to harm. But watch out for it. Okay?
Hey, and shout out to you for recognizing that, because definitely we it always gets brought up about the disparities between men and women, especially in the tech and crypto space, as we get more and more into the niche. So, big ups to her. And if she's any half as smart as you, your son, I'm sure she is, probably twice as smart as you.
Well,
she'll do great in life.
once it comes to advanced math, she has us all beat. Both of my sons and me. It doesn't take a lot to beat me at that, but my sons are pretty bright. So, of course, I teach her to speak up. So she made it very clear, Dad, you're sexist, right? So, so we're going through there, and I'm explaining to her. They have these guys. They have several investing in NFT. Guys are saying, well, we use old school market fundamentals and diversification. So they wouldn't take questions, because they did, and I'm going to okay. But I'm like, well, how do you do a risk-adjusted reward analysis on NFTs? They're not talking about NFTs. They're talking about Board Yacht 8 Club and JPEGs. Okay, they're not talking. Nobody raised the prospect of true IP risk. There's this relatively tall, roughly 6'2", extremely handsome, hyper intelligent brother who actually has a patent that covers the transfer of NFTs, particularly through aggregators such as OpenSea and et cetera. Nobody's discussing the fact that the guys and girls who are aggregating this stuff and selling it are doing it on a platform that's been patented many years ago by more than one entity as well, not the only one. Okay, nobody's discussing that. Tangential discussion on trademark IP, but Nike and Birkin and everybody else are taking it very seriously. They're throwing money behind it. The stuff is just ridiculous. So not only are they not applying the true potential of NFTs where it should be applied, sovereign IDs, contracts where NFTs are perfect for, because no two contracts are exactly the same. And if you're going to apply it to media for real. NFTs could be used to replace Tidal and Spotify easily. The contract can control the flow, right? The payment.
I've seen a couple of platforms where they were doing that, where they were creating NFTs. Like an artist made a song, made into an NFT, and then of course they released say 700 tokens of that NFT, and however many plays the song or the NFT got from other people, you could receive residuals or whatever the case was set up for that. And I think also one of the big things I've seen is tickets, like concert tickets, sports tickets, any kind of ticket to an event is like a perfect use case for an NFT, especially you go on not YouTube, eBay, and see old tickets from Tom Brady's last game or first game selling for thousands of dollars, where that could be a use case of the NFT. So definitely there's a lot of utilities out there besides like the Bored Apes or JPEGs or Smoking Monkey or something like that, where people are kind of discussing more so about.
Even better, okay. NFTs can replace the distribution houses. Sony Records, Sony Music, Sony Movies, Sony Studios, MGM, Paramount, all replaced by NFT technology. Like you create the movie, right? Each copy of the movie will be an NFT, okay? And that NFT, again, can regulate and meter views, payments, and those payments can go directly to the source, the creator. Okay, so the only reason to go to a record company or movie studio is A, funding for production, and B, distribution. Okay, funding is now available from everywhere. You can kickstart funding for a movie. Okay, distribution, back in the days, right about the time you were born, right, was only available from, a big movie house through the movie theater. Now, everybody's streaming. More people stream than go through the movies. Okay, movie theaters, if you look at them, they're closing down. So why would you give
but hey, AMC accepting Dogecoin, everybody to the
movies. Why would you give 95% of your earnings, potential earnings, to a distribution house who's going to turn around and distribute it through the same channel you would? So the only thing left now outside of production, distribution, would be marketing. And that's the one thing that you wouldn't be able to do on your own, right? Wrong. So you raise your $25 million in marketing directly into social media marketing. What would 25 million, we discussed this before. What would $25 million buy you in terms of Instagram, Facebook, Twitter, and YouTube ads and Google ads?
You could probably take over a whole month of advertisement with that.
Right. So your movie should go up.
Right.
So I just explained how to take an NFT and replace Sony Studios and Paramount. Same thing with Sony Music. That's what an NFT is for. So please,
man,
with the bored apes and
we already got a couple entities already listening and canceling the our ads on the video. Now MGM gonna come at us. So
let me why
ask you,
nobody ever wants to put me in the mainstream anymore, but it doesn't matter. In about a month, in roughly a month, I'm gonna hit it probably still won't come up in Cointelegraph or Coindesk. They do, they're gonna try and label me as a patent troll or something. But remember, an inventor can never be a patent troll. He was the first one to use it. That's how he invented it. Just remember, use your brain and don't follow the boogeyman tactics of the multi-century billion-dollar entities who are trying to keep David down so Goliath can stomp him. Okay, sometimes David wins.
Hey, same tactics. I mean, old tactics is new scenarios.
Yeah.
So let me ask you, with NFTs, like for example, in regards to your IP, like for instance, we have protocols like Polygon, and we've talked about before. They offer scaling solutions where, say, me as an individual, I can create my own blockchain network and mint NFTs or do whatever I want for my decentralized app or program. And those type of instances, of course, Polygon, as you say, possibly infringes on your IP. What about those people who are using that as well, like me, just as an individual? Would I be at the mercy of whatever Polygon happens to, or could I be held directly liable in those instances as like a small person, not like a big enterprise?
Okay, I'll put a good example to this. I'm not going to answer directly. I'm going to give you an example. Apple and Samsung have been at each other's throats for like at least 10 years because they're the number one and number three. Apple, I think, is the number 3 producer, and Samsung's number 1.
The Brinks trucks with the pennies is my favorite story.
So they've been at each other's throats, fighting suits back and forth, right? How has that affected you?
I still got my Samsung.
Yeah, you got your Samsung, right? Nobody comes for you. Apple doesn't come for you for patent infringement because you're doing that. You have your iPhone. Samsung never came to you for patent infringement because you use the iPhone. Right? This is between the big guys or a little guy and a big guy, but the little guy is not trying to take anything from you. They're trying to tell the big guy, you cannot make money off of my property. Okay? So if you're going to use my property, pay for it or don't use it. It doesn't affect the end user at all. Over time, it helps because it forces either the big guys to create their own stuff or to compensate the little guys for using it, which gives the little guy both an incentive and the money to create more stuff. That's why your Samsung, I did a video a little over a week ago trying to convey this message where I had a rotary phone that I don't have close to me. And nobody knew how to use the rotary. Everybody's in their 20s and 30s. Nobody they're pushing buttons on the phone. I'm like, no, you put the string in a hole and you turn it and it goes back. They're like, how's that work? How do you text on it? And there's no camera. And so basically, the rotary phone came off a patent, which was obtained by Alexander Graham Bell in 1882. It came off a patent in 1902. And pretty much from that point on, no major patents occurred until smartphones, okay? Right. Except for maybe some touch tone stuff. When the smartphones came up, you have probably the most aggressive patent battles in the history of business in the US. And everybody says that slows down innovation, et cetera. You can take your rotary phone and you compare it to your Samsung, which does 8K video recording, 5G communications through a wireless network, which is faster than anything before that was wired or not, just 6, 7, 8 years ago. It does high-speed memory, storage, 4K video screens on a Sony, 2K in a Samsung, a little less than an Apple. Basically, all types of fantastic things, unprecedented. Okay, movie production studio.
Small smart computer.
Right, sound production studio, full communications. All that came from the iPhone 13 has roughly 200 patented components and pieces just from Apple. Another 1,000 from other vendors. Bluetooth, which comes from Sony Ericsson. Ericsson in the, I think.
Yeah, they're in Switzerland, I think, right?
Switzerland, yeah. Samsung with chips, screen technology, LG with screen technology, Samsung with memory, on down the line. Okay, even Microsoft with email software components, etc. So 1,200 patents going and making the iPhone. Do you mean to tell me? And I don't like iPhones. I don't think they're very capable. But do you mean to tell me that?
I don't either.
Do you mean to tell me that iPhones don't represent technological progress? If you're like me and don't really respect the iPhone, look at the Samsungs and the Huawei's, which represent extreme progress. All that comes from all of that is patented technology. So blockchains are going to go the exact same route. So if you preach open source, open source, open source, let's assume we can only have open source and blockchains. You're not going to grow but so fast, so far. But you start plugging in patented technology, now those blockchains are going to do fantastic things. Built-in 5G, built-in Wi-Fi, which is patented, built-in Bluetooth, software Bluetooth modules that could be replicated through a virtual machine. Could you imagine that? Right? Bluetooth capabilities through software. I'm just talking off the top of my head. I don't know if it could be done, but if you think about it, the virtual machine itself is a virtual computer.
Right.
Ethereum is a state machine. It's a computer and it's software.
Literally every token that you look at, every project says how they are an Ethereum virtual machine compatible.
Right. So if Ethereum is a virtual machine, and a virtual machine is like a virtual processor spread upon many different nodes and computers, and smart contracts or software that runs on a global computer. If you open your mind and think about what's actually going on, and think about what happens when you plug in intellectual property from all over the world, not based upon whether it's open source or not, but based upon its functionality. Then yes, the patent holder should be paid, of course, but you pay him his 1 or 2 pennies. And now your virtual machine, the state computer, is that much more capable. And that's called progress.
And we're at that turning point in progress now where some of those things that you mentioned, we don't know if it can be done, but hey, people are going to be trying it.
Yeah.
And I have one last thing I wanted to talk about with NFTs, Reggie. You said that they didn't have you speak. Man, they got about 1,000 speakers at this NFT NYC. I'm talking about it's a long list. So
I mean, I don't really care about speaking to it, but it is interesting because I don't want to. I want to communicate by lifting up and not putting anybody down. So my grandmother used to tell me, if you have nothing nice to say nothing at all. So I'm not going to opine upon speakers. I don't know most of them. Okay. But there are different dimensions you can add. Like this conversation that we had would have been very interesting at the NFT conference. And the fact that there's no discussion of IP, and I'm not a lawyer, is interesting. There's going to be a popping of the IP bubble in 2022 going into next year, and it's going to be very painful. Okay.
Well, and I remember Zay and King mentioning a lot of times before that during bear markets is where we'll see a lot of regulation coming down and things like that. So how would your IP have to would that I guess take any hit or be involved, or do you need to pay attention to like anything coming down from the government in terms of regulations within the space? Does that have any effect on your dealings?
Two different topics. To be truthful, even the government has not paid attention to IP. The enforcement arm of some of these agencies has been using technology nilly-willy, not bothering to pay attention to who it belongs to. I get the feeling they're going to get stopped. We'll see. I can't predict the future. I don't know. But, I get the feeling even they'll be shocked. Everybody listens to the full bankers and the full traders and the regulators who ulterior motive, in my opinion, is to expand their power, grasp, and budget versus actually protecting the people espousing their mandate. And they actually believe this stuff is about financial products. Like, it's a technology that can enhance financial products and enhance financial services. But at the end of the day, it is technology. They're not stocks, they're not securities, it's technology. So they're being treated as stocks or being treated as securities, not stocks necessarily. They're being treated as securities of financial products. And a big hand is going to smack a lot of people in the face and make them up. You can't get IP infringement suits from a security. You definitely get it from intellectual property that's been patented. And you can't get trademark. You can, but it's unlikely to get trademark issues. You can get a lot of copyright issues. You know, the amount of sloppiness and the due diligence is mind-staggering. I mean, I look at it.
Shoot,
like,
we were just talking, even with just the marketing money going around, you know, right before we got on the live, we were talking about, you know, FTX pulling out of some of the deals that they have with major sports corporations that are worldwide in terms of revenue. And, you know, now a year later, they're pulling out of these major deals. And it's like, you know, do these people signing the dotted line and shaking hands really know, you know, everything that's entailed within the technology? And it's clearly that, you know, they don't. But I did want to bring up one more topic, Reggie, and it's regards to this short Bitcoin ETF that ProShares launched. You can see my screen, right? Or you can see
I see it.
Okay. So, and you mentioned here that, and again, the community, the crypto space, whatever you want to call it, everybody was looking forward to an actual Bitcoin ETF. You know, there were a lot of people against it as well, but here we see that there's a quick ETF to short Bitcoin within a couple of months of it, you know, being on the price being on the downtrend. So, what do you care to explain or expound upon your thoughts a little more on this? I think you're muted. I can't hear you. Can you hear me, Reggie? Uh-oh. I can't hear you. Can you hear me? We're having technical difficulties again. Hello? All right, 1 second. All right, while Reggie's fixing up his thing, y'all just got me now. I ain't as interesting or as smart as Reggie, but I'll hold it down while we get him back in for a second. My quick thoughts on this. I mean, this is obviously a setup, in my opinion, just because we weren't able to get. Now, sound still not working, Reggie. Sound still not working. Can't hear you. I can't hear you. No. All right. Well, it's clear we're gonna have issues again. But all right, we'll try one more time. So again, my thoughts on the short ETF is Cryptonomics, you a fool, man. But my thoughts, you want people to, what is it, the fear and greed, when people are being fearful is when you should be greedy. And we see that sprouted many times, but I think when they're creating this short Bitcoin ETF, like if people think or know that this is going to keep diving down, they want people to put their money into an ETF that's shorting it. I don't know. It just seems like a setup play to me, where, you know, people start putting in their money into this ETF thinking Bitcoin is going to keep going lower, and then next thing you know, all the major corporations or, you know, whales buying up some of the Bitcoin. You know, they're going to, hey, we're buying this up down here at these major levels, support levels. We're hitting previous highs from what, 2017.
Okay, I hear you now.
Okay, I can hear you now too.
Can you hear me?
Yeah, I can hear you now.
Okay.
Your
So
video
what
is
were you
not
saying
showing
now?
though.
Okay, 1 second.
Yeah, no problem.
Okay.
Yeah, I was just actually, let me make sure I got the right. Yeah, so I just had up your tweet. Can you still hear me?
I hear you. Very, very
Okay.
faint, but I hear you. Go ahead.
Okay. I was just bringing up and asking what your thoughts on this short Bitcoin ETF provided by ProShares.
Yeah. Well, honestly, I'm gonna be blunt. It shows basically an incentive or evidence that they're looking for Bitcoin, the doom and gloom of Bitcoin. You know, if I'm not mistaken, the reason why a spot Bitcoin ETF wasn't approved was a lack of consumer protection, retail investor protection. Okay,
It was too
it's
risky.
volatile. There's not enough price discovery. There's no centralized price source. You know, basically, it's very decentralized and fragmented. Okay, I agree with that. The volatility, though, is what investors are looking for. Oil is volatile, okay? But I'm not going to second guess them. That's what they want. So they're looking to protect investors. So they're not going to allow a long spot ETF, but they'll allow a short Bitcoin ETF powered by futures. So wait a minute. So a long Bitcoin ETF is too risky, but you'll go a short Bitcoin ETF powered by futures. So which is riskier to you? You go long a stock or you short a stock through the futures market?
Anybody who's been trading or just basic knowledge would know that a short on futures is a lot more risky than long in anything.
A short period is riskier, but a short on futures is even more riskier. And if you think Bitcoin is volatile, then a Bitcoin future is going to be much more volatile. So how in the world you're going to say this is too risky, but something 5 times as riskier is good enough? You know, basically, they are just, you know, they don't want to spot Bitcoin ETF.
Yeah, and
No?
to me, and I was sharing my thoughts. Honestly, I think this is just kind of a money grab towards the retail people mostly, or retail investors. Just because, you know, especially if you don't know too much about it, or if you're like, oh, it's going to keep going down when we're already took a drastic drop. I don't know. It doesn't sit right with me seeing this. I just think it's more to it, but it's usually always more to it in these type of findings in within the space.
Yeah. I mean, I looked at that and I'm like, come on, man. You know? But it is what it is. I mean, you shouldn't be investing in any of that stuff anyway at all. You know, you want exposure to Bitcoin, buy Bitcoin.
Right.
You know, you want to short Bitcoin, then you short Bitcoin. Now, if you short Bitcoin, chances are you're probably going to have to go through a centralized exchange. That's going to take you're going to put a lot of excess counterparty risk in. Okay? And you're going to pay a lot of excess fees. But you probably pay less than the ETF anyway.
Right. at least you're in control of it, right?
Yeah.
But I think with that, Reggie, we can go ahead and end it off for today. I do got to run here shortly. I think that's all from my end. Did you have anything that you wanted to leave the people with today on this fine Wednesday?
I'm good. You know, we seem to have a technical problem each and every single time we do this. But you know, that's all right though. We persevere. Again,
hey, push through it.
I think the content that we put on together is some of the best in the net, and to spread this word around. If you want to discuss this, I don't always go to the comment section, but I will shortly thereafter. But I'm always on Twitter. So ask me questions. Any bankers you think you're not salesmen, come at me. Let's dance. Okay. And anything else you want to discuss? The FTX pulling out of those deals. It goes to show potentially, and I'm not trying to knock anybody, okay, a lack of maturity and experience in management. They went into deals big time, and less than a year later, they pulled out. I'm assuming they pulled out due to volatility and cyclicality in the markets, but that is the name of the game, and this particular market is one of the most volatile and cyclical, okay? So this is the time where you should be buying and locking up as many deals as possible. Number one, those deals should be cheaper because everybody's in fear mode. And number two, you have a lot less competition, which also makes it cheaper. Okay? So I'm not saying that's the case. Obviously, the guys that lead FTX have done a very good job. So I'm definitely not knocking them at all. But I see the signs of the potential of a lack of experience in management. Or something could have happened. Who knows? I'm not in the inside. Right. So that's why I'm not knocking them, you know?
Right, definitely will. I know I'll be paying attention to that. I love sports, so seeing them pulling out these deals just raises a eyebrow. But we'll definitely keep an eye out for this and everything else. And with that, everybody, thank you for tuning in. Make sure you like, share, subscribe, and also check out the other shows that the Gentleman of Crypto has going on in the community. And with that, peace, everybody. Have a good one.
Okay. Peace at Reggie Middleton Twitter. Okay.